Good morning, everyone. This is Marshall Giller bringing you the morning comment for February 13th. Yesterday was a great example of the monetary policy divergence that's driving some Forex rates nowadays. Faced with similar circumstances, the Riksbank and the Bank of England interpreted the inflation outlook totally differently. The Riksbank saw signs that, quote, inflation has bottomed, unquote, but it cut rates nonetheless, in part because of lower oil prices. In the UK, however, Bank of England Governor Carney dismissed lower oil prices as just a temporary factor and emphasized that the bank is on the path to hike rates. Britain's monetary policy is clearly diverging from other countries, and this should support sterling on the crosses going forward, although perhaps not as much against the dollar, which is also on the path to hike. As we approach the elections in May, though, a political risk may come to the fore and sterling may weaken again, as there are several possible results of the election that could be disturbing to markets. Now, after 4 consecutive opens with a 113 handle, the eurodollar is starting trading today in Europe at 114 and change. The ceasefire in Ukraine has boosted the euro, while weaker than expected U.S. retail sales hurt the dollar all around. The recent pattern is for U.S. retail sales to disappoint and for eurodollar to move higher on the day, but for the move to reverse the next day, so watch out today. Also, eurodollar is being boosted by talk about a compromise between the EU and Greece. Now, this is big stuff. According to Bloomberg, as long as Greece sticks with its reform program, Germany might be willing to let up a bit on the austerity. For its part, Greece is prepared to commit to a primary budget surplus as long as it's lower than the current level. The German newspaper Die Welt said a deal could be reached by the deadline next Monday. This seems to me to be a reasonable basis for a compromise. It would be very good news for the euro and indeed for risk assets overall, as it would remove the biggest risk hanging over the global financial system. A solution to the Greek problem might therefore be negative for the yen and the Swiss franc, as it would diminish any safe haven demand. Today's highlights: during the European day, the spotlight's on the preliminary fourth quarter GDP figures for France, Germany, and the Eurozone as a whole. France's GDP grew 0.1% quarter on quarter, as expected, but Germany's GDP beat expectations tremendously, rising 0.7% quarter on quarter instead of 0.3% as expected. The previous figure was only 0.1%. This creates some upside risk to the Eurozone's preliminary GDP rate for the fourth quarter, which is expected to have remained unchanged at 0.2% from the third quarter rate. In the U.S., the preliminary U of M consumer sentiment for February is expected to remain unchanged at its highest level since January of 2004. The surveys of 1-year and 5 to 10-year inflation expectations are also coming out. While expectations for inflation 1 year ahead have been trending lower, expectations about inflation over the longer term remain steady around 3%, which is quite sufficient given the Fed's inflation target's only 2%. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.